Have you ever wondered what really happens when the stock market crashes? Does all the money disappear? Or is it just an illusion? Today, we're going to break it down in simple terms so you can understand where your money may go when markets tumble. By the end of this video, you'll understand why stock prices fall, where money moves during a crash, and how you can make sense of market fluctuations without panic. We'll go step by step with simple examples and stories that make sense even if you've never studied finance. The stock market can feel like a roller coaster. One day, prices soar, the next, they drop sharply. Many people panic, thinking the money is gone forever. But the truth is more subtle. During a crash, value can shift, some investors sell in fear, and others buy strategically. Understanding the flow helps you stay calm. 1. What is a stock market crash? A stock market crash happens when stock prices suddenly fall by a significant amount in a short period of time. It's usually a rapid decline, much faster than normal daily fluctuations. Crashes can happen for many reasons, and often it's not just one factor, but a mix of events that trigger them. For example, it could be disappointing company earnings, unexpected economic news, rising interest rates, geopolitical tensions, or even a wave of panic among investors. Think of it like a busy flea market. Imagine a popular stall selling rare items. If buyers suddenly decide the items aren't worth the price, many people might try to sell their items at once. Prices drop sharply, not because the items disappear, but because there are more sellers than buyers. The same principle applies to the stock market. When too many investors try to sell at the same time, supply outweighs demand and prices fall quickly. During a crash, major market indexes like the S&P 500 or the Dow Jones Industrial Average can lose 10% or more in just a few days. Some crashes are even steeper, like the 1987 Black Monday crash, where the Dow fell over 22% in a single day, or the 2020 COVID-19 crash, when global markets dropped about 30% within weeks. Even smaller crashes can feel dramatic because they happen fast, and the sudden drop often triggers anxiety and fear among investors. The key point is that a crash is a reflection of changing sentiment and pricing in the market. Companies themselves don't disappear overnight, and the underlying economy may still be functioning. What changes is how investors value stocks in the moment. Understanding this can help you stay calmer and make better decisions during volatile times, instead of reacting purely out of fear. 2. The illusion of lost money. One common misconception about stock market crashes is that money disappears into thin air. People often panic, thinking the market has eaten their cash. In reality, it's usually more about paper value, the current market price of your investments, rather than actual money vanishing. Stocks represent ownership in a company. Each share is a small piece of that business. The price of a stock reflects what buyers are willing to pay at a given moment. That means prices fluctuate all the time, sometimes sharply during a market crash, but the underlying company still exists. Let's take an example. Imagine you own 10 shares of a company, priced at $100 each. On paper, your total investment is worth $1,000. If the market drops and the share price falls to $70, your 10 shares are now worth $700. Many investors feel like they've lost $300, but it's important to understand, no money has physically disappeared. Your shares are still yours, and the company continues to operate. The drop simply reflects the new market valuation at that moment. The market value of a stock is determined by supply and demand, who's buying and who's selling, and what they are willing to pay. During a crash, many investors may sell out of fear, pushing prices lower. Others may see it as an opportunity to buy at a discount. The change in value is more like a transfer of potential wealth than a true loss of cash. 3. Where does the money go? When stock prices fall, money isn't sent to a secret vault or stolen. It's really about value transfer. Sellers receive less. If someone sells during a crash, they may get less than what they paid. The lost money is really the difference between the old market price and the new sale price. Buyers take the opportunity. Someone buying at lower prices now owns the same shares at a discount. 4. Psychological factors in a crash. Human behavior plays a huge role. Fear can lead to panic selling, which accelerates price drops. Herd mentality. When one investor sells, others often follow, fearing further losses. Overreaction to news, bad economic reports, or global events can trigger selling even if companies are fundamentally strong. Loss aversion. People feel losses more intensely than gains, prompting rapid selling decisions. These psychological factors mean that much of a crash is temporary value reallocation, not actual destruction of wealth. 5. Role of institutions and hedge funds. Big investors, like mutual funds, hedge funds, and pension funds, also influence where money flows during a crash. Hedge funds, they may short sell, betting on price drops. This can make declines appear faster, but also creates opportunities for others. Institutional buyers, when prices fall, large investors may buy discounted shares. Their purchases inject liquidity and stabilize the market over time. Mutual funds, they adjust portfolios, selling weaker assets and buying stronger ones, shifting money within the market. In short, professional investors redistribute capital rather than eliminate it. 6. Example, 2020 COVID crash. In March 2020, the S&P 500 dropped over 30% in a few weeks. Headlines screamed trillions lost. What actually happened? Investors sold shares in panic. Prices dropped to reflect uncertainty about the economy. Some funds and savvy investors bought the dip. By the end of the year, the market rebounded, and many investors recovered or even gained money. The lost trillions were largely temporary valuation changes, not literal disappearance. 7. The difference between market value and realized losses. It's important to understand two key concepts when thinking about stock market crashes: market value and realized loss. Market value is the current price of your shares. It changes constantly, sometimes daily, as buyers and sellers adjust what they're willing to pay. This means your portfolio value can go up or down even if you don't make any transactions. Realized loss happens when you sell your shares for less than you originally paid. Only then is the loss locked in. 8. The role of derivatives in complex financial instruments. Some crashes are worsened by derivatives, options, and other instruments. These allow investors to bet on stock movements without owning the shares. When markets fall, leveraged positions can force automatic selling, pushing prices lower. Again, this is more money movement than disappearance. 9. The ripple effect on the economy. A stock market crash can affect businesses and individuals. Companies, lower stock prices can make it harder to raise capital for projects. Employee stock options lose value. Investors, portfolio value drops, potentially affecting retirement accounts. Even so, the market often recovers over time, showing resilience. Money isn't destroyed, it's redistributed, sometimes temporarily trapped in lower valuations. 10. Why markets recover. Markets generally recover because businesses continue to operate and generate profits. Investors eventually see value and buy stocks at lower prices. Governments and central banks may intervene with policies to stabilize the economy. History shows that most crashes are followed by recovery periods. Understanding this helps investors avoid panic selling. If this video helped you understand market crashes better, give it a thumbs up. Subscribe for more clear, simple breakdowns of finance and investing topics. And check out our next video where we explain how to spot investment opportunities during market dips.